between corporate leadership and the alleged operational realities on the ground.
Okay, this brings us to a really powerful question that you, our listeners, keep asking, and it's fueled by this alleged behavior we just discussed. How can these companies rake in billions in profit
hmm
while simultaneously claiming financial distress and demanding exorbitant rate hikes, especially after devastating fires and hurricanes where, as you noted, policyholders are often left struggling for years without a penny, their homes unrebuilt? It just doesn't make sense on the surface, and understandably, it fuels a lot of anger and that feeling of being scammed.
It's a really complex picture, financially speaking, as your sources clearly reveal, and it's anything but straightforward, which is precisely why it generates so much public skepticism and frustration. Let's look at the numbers presented in the materials. Senator Josh Hawley, for instance, directly confronted an Allstate executive. He pointed out that Allstate, as a whole company, had $64 billion in revenue and made $4.6 billion in profits in fiscal year 2024.
$4.6 billion in profit.
Right. And during the same period, its CEO earned $26 million. All this amidst these swirling allegations of claims manipulation and delayed payouts. So that clearly indicates substantial overall profitability for the company at the corporate level.
Okay, big profits overall. But then what about specific places like California?
Exactly. When we shift our gaze specifically to individual markets, like the California homeowners insurance market in 2023, the picture changes quite dramatically according to the data presented.
How so?
In that specific market, major insurers reported significant losses. State Farm apparently lost approximately $7.567 billion. Farmers, about $5 billion. Berkshire Hathaway, $4.5 billion. Allstate, $4.1 billion. And Auto Club Enterprises Insurance Group, $3 million.
Well, those are huge losses in just one state.
They are substantial figures in a single state market.
So on one hand, we have billions in overall corporate profit and eye-watering executive salaries. And on the other, billions in market-specific losses that are impacting ordinary homeowners through rate hikes and non-renewals. It feels, as one listener described, like a corporate shell game designed to obscure the true financial picture. How do we, as informed citizens, reconcile this apparent disconnect? It feels like they're saying, we're broke in California while swimming in cash overall.
This apparent contradiction points right back to that key and often misunderstood aspect of the modern insurance business model we touched upon earlier.
Big investments.
Exactly. As we discussed, insurance companies don't solely make money by collecting premiums and then paying out claims. They actively and aggressively invest those collected premiums. They take the premium from thousands of policies and invest that money in another financial product across the global financial markets.
Yep.
So a company can technically pay out more claims than they make in policy premiums in a specific market, like California homeowners insurance, or in a particularly challenging year with lots of disasters.
So they can lose money in one place.
Yes. But they can still be highly profitable overall through those high-interest investment schemes. Their overall investment portfolio, or their business in other states or other lines of insurance, could be generating immense profits that mask the losses in one specific area.
So the California losses might be real for that specific line of business, but the company as a whole is doing just fine. Thank you very much.
That's the complex picture the numbers suggest. Insurance, in this sense, acts as that powerful mechanism for creating cash flow to be used in more lucrative investments, deeply intertwining it with the financial sector in a way that often makes it opaque to the average policyholder.
And these market-specific losses are then used to justify some very unwelcome news for policyholders. Soaring rate hikes and, in some cases, outright market exits, leaving people desperate for coverage. This is where the rubber really meets the road for individuals, isn't it?
That's precisely right. Insurers like State Farm and Allstate cite a confluence of factors as their primary reasons for limiting or ceasing new policies in California and demanding rate hikes.
What are they saying?
They point to historic increases in construction costs and inflation, which drives up repair costs. They talk about rapidly growing catastrophic exposure, more frequent and intense wildfires, hurricanes, etc. And they mention a challenging reinsurance market.
Okay, reinsurance. Can you break that down quickly?
Sure. Reinsurance is essentially insurance for insurers. It's how insurance companies offload some of their own risk, pooling it further with giant global reinsurers. Think of it like a pyramid. You insure your home, your insurer insures their whole portfolio of homes with a reinsurer, and that reinsurer might even reinsure their exposure with other reinsurers.
So layers of insurance.
Exactly. And when the cost at the top of that pyramid goes up, maybe due to global disasters or financial market conditions, those costs inevitably trickle down, adding to consumer premiums. The insurers argue they can't legally force somebody to operate at a loss in a specific market, hence the need for higher rates or the decision to withdraw.
Which leads to another factor, these complex computer models they use.
Right. Another increasingly influential factor in setting these rates, as the sources discuss, involves increasingly sophisticated yet often opaque computer models that predict future risks.
Future risks, not just past claims.
Exactly. Insurers are very keen to use forward-looking computer catastrophe models to assess future risk. This allows them to move beyond just historical data, which might not adequately predict the frequency and intensity of modern climate events, and instead project potential future losses from, say, wildfires or floods.
But we don't get to see these models, right? They're secret.
That's the controversy. These models are proprietary intellectual property and are not public. This lack of transparency leads to significant skepticism from consumer advocates. They worry about the model's fairness, accuracy, and their ultimate impact on affordability. Are they just tools to justify higher rates?
So it's a black box.
Pretty much. It's why the state of California is now actively aiming to create its own public catastrophe model. The explicit goal is to keep the private models honest and provide a verifiable benchmark that regulators and the public can scrutinize.
That seems like a good step. But regardless of the complex financial justifications and the black box of these models, the direct impact on individuals is what truly fuels the widespread public outcry and that deep-seated feeling of being taken advantage of. People are paying way more if they can even get coverage.
And that outcry is not just anecdotal, it's palpable and measurable. Homeowners, for instance, are finding new insurance policies 166% more expensive. That's a specific figure cited for someone in San Ramon.
166% more. Wow.
We hear countless stories of real estate deals collapsing because potential buyers couldn't afford the insurance required by their mortgage lenders, even after qualifying for the loan itself.
So you can afford the house, but not the insurance to get the house.
Precisely. People are experiencing profound sticker shock when they receive their renewal bills, often for less coverage at a much higher price, forcing them into impossible choices. This isn't just an abstract financial discussion, it's creating a very tangible and widespread financial burden, affecting people's ability to own homes and maintain financial stability.
So this raises a crucial question that you, our listener, continue to ponder. Why do we allow it? How is this system allowed to operate in this way, where we see such massive profits alongside serious allegations of claims manipulation and significant rate hikes, often met with what appears to be an almost impenetrable wall of corporate denial? It makes you wonder how these companies ended up in charge and were allowed to weasel their way into cars, houses, pets, people, electronics, driving, sports, banks, as one listener put it. It feels like they're everywhere and untouchable. Let's talk about the regulatory framework, or maybe the lack thereof.
This is an important, indeed a critical piece of the puzzle, and it speaks directly to that feeling of powerlessness. Insurance regulation in the U.S. is primarily handled at the state level.
Not federally.
Mostly state level. It's a legacy stemming from the McCarran-Ferguson Act of 1945. This means there are essentially 50 different regulators, each with their own set of rules, priorities, and, frankly, resources and political pressures.
50 different systems. That sounds messy.
It is. While this fragmented approach can make it particularly difficult for insurers to navigate sometimes, constantly dealing with different state rules.
Oh, poor them.
Well, it also creates a patchwork regulatory landscape with potential gaps. It makes it incredibly challenging to implement unified federal oversight or address systemic issues consistently across the nation.
Is there any attempt to coordinate?
There is the National Association of Insurance Commissioners, the NAIC. It exists as an association that tries to standardize legislation across states by proposing model legislation.
Model legislation. So, suggestions.
Exactly. It's not a government organization with enforcement power. It only offers guidance that states can adopt, but they don't have to. This fragmentation fundamentally hinders a unified approach to systemic issues, allowing problems like the ones alleged to persist in different forms across different states.
And it's not just about the fragmentation of rules. It's profoundly about who gets to write them, or at least who gets to influence them. It sounds like insurers actively shape the very rules meant to govern them, almost like they're writing their own playbook or heavily editing it.
What's fascinating and deeply concerning here, based on the sources, is the extent to which the industry often influences its own oversight. It's a phenomenon sometimes referred to as regulatory capture.
Capture, like the regulator works for the industry.
Not necessarily directly, but the industry wields significant influence. Look at California, for instance, under the proposed sustainable insurance strategy by the state.
Which we'll get into more detail on later.
Right. Insurers are demanding significant concessions. They want the ability to use those forward-looking catastrophe models we talked about and to factor in reinsurance costs, which are currently not reviewable by the public when setting rates.
And what do they offer in return?
They offer it in exchange for not abandoning the market entirely and committing, vaguely perhaps, to writing more policies.
So basically, let us charge more using our secret models or we walk.
That's how critics portray it. This dynamic puts insurers in an incredibly powerful negotiating position to influence the very regulations meant to oversee them, often resulting, critics argue, in higher insurance rates for consumers and potentially fewer protections.
And does the oversight itself seem transparent?
While adding to the concern, the sources highlight questions raised about the transparency of oversight itself. California's insurance commissioner, Ricardo Lara, faced scrutiny for missing travel records and a lack of transparency regarding taxpayer-funded trips during critical insurance hearings. Things like that understandably erode public trust and don't help instill confidence in the regulatory process.
Right. That doesn't look good. Now, to really underscore the immense power and interconnectedness of this industry with the broader financial system, we have to bring up the AIG bailout in 2008.
Yes. The big one.
Many of you wondered, why did it happen? Who truly benefited? And why did the government commit such a staggering amount of taxpayer money, $182 billion, to an insurance company?
The AIG bailout is a profound, indeed infamous example of the too-big-to-fail dilemma playing out on a global stage. In 2008, the U.S. federal government committed that staggering $182 billion to bail out AIG, which was then the biggest insurance company in the world.
Why? Was it to protect policyholders?
Not primarily, no. The main driver behind this unprecedented intervention was to avert what was termed systemic risk.
Systemic risk, meaning the whole financial system could collapse.
Exactly. AIG's failure, regulators feared, threatened to unravel the entire financial system. Its complex financial products, particularly its credit default swaps, which were essentially insurance on mortgage-backed securities, were deeply interwoven with major banks globally. Its collapse could have triggered a cascade of failures across banks and financial institutions worldwide, potentially causing all kinds of things to go wrong and leading, some feared, to another Great Depression.
So it wasn't about saving Joe's home insurance policy, it was about saving Goldman Sachs.
Well, while AIG shareholders lost almost everything, over 90% of their value, the true anger, as the sources put it, stemmed from the fact that powerful business partners, notably Goldman Sachs, who were counterparties to AIG's risky contracts, didn't lose a penny. They were made whole by taxpayer money flowing through AIG.
Taxpayers bailed out Wall Street banks via an insurance company.
That's certainly how it was perceived by many. This event starkly highlighted a profound lack of regulatory information at the federal level. Regulators admitted they had not collected such information to understand the full extent of interconnected risk in the shadow banking system, where AIG operated heavily.
So they didn't even know how bad it could get.
Apparently not fully. In response, the Dodd-Frank Act in 2010 created a federal insurance office specifically to monitor systemic risk within the insurance sector going forward. And critically, the act explicitly stated, "We will not bail out another insurance company the way we did AIG."
Ames' last words, maybe.
Perhaps. But it indicated a legislative commitment to prevent future recurrences of such a massive government intervention for a private entity. The bailout itself, however, left a lingering sense of injustice and a clear message. Some financial institutions are indeed deemed too important to fail, regardless of the cost to taxpayers or the moral hazard it creates.
So that was a huge financial safety net at the federal level for the system. But what about the individual policyholder? Is there any safety net for you when your specific insurer fails, outside of a massive federal bailout that might never happen again?
Yes, there is something. There are state insurance guarantee funds.
Yeah.
They're somewhat akin to the FDIC for banks.
Okay, so they protect your policy if the company goes bust.
They do, up to a certain limit. These funds protect individual policyholders if a licensed insurer becomes insolvent. The limits vary by state, for example. The sources mention $500,000 in New York and Connecticut, but typically it's around $300,000 in most other states for homeowners insurance claims.
$300,000 might not cover rebuilding a house in many places today.
That's a key point. These funds were also described as way too big for AIG to handle, illustrating their inherent limits when faced with a truly massive failure. And you're right, the limits are often insufficient for major life
Like
events.
rebuilding after a total fire loss.
Exactly. Or, as one source notes, sending two children to Yale could easily cost $500,000, far exceeding many state fund limits for, say, a life insurance policy payout. So, while a safety net exists, it might not fully cover catastrophic losses.
Are there other catches?
Yes. In some states, insurance companies aren't allowed to advertise this protection, which makes it less transparent to consumers. You might not even know it exists. And importantly, the limits usually apply per person, per insolvency, not per policy or per bank account like FDIC, where you can spread money around. It's a protection, but one with significant caveats and often an insufficient ceiling for life's most profound financial losses.
Okay, let's shift our focus now specifically to California, which has become such a stark, real-time case study illustrating many of the issues we've been discussing. This isn't abstract theory. This is a crisis affecting hundreds of thousands of you directly, right now.
California's home insurance crisis truly exemplifies the immense strain on the system. It's amplified by climate change, rising costs, and the industry's changing risk assessments we've talked about. And at the heart of it, for many people, is the California FAIR Plan.
The FAIR Plan, that's the state one, right? The insurer of last resort.
Exactly. It was originally established way back in 1968 after a series of devastating brush fires and civil unrest made it difficult for property owners to get coverage in certain areas. Can spread money around. It's a protection, but one with significant caveats and often an insufficient ceiling for life's most profound financial losses.
Okay, let's shift our focus now specifically to California, which has become such a stark, real-time case study illustrating many of the issues we've been discussing. This isn't abstract theory. This is a crisis affecting hundreds of thousands of you directly, right now.
California's home insurance crisis truly exemplifies the immense strain on the system. It's amplified by climate change, rising costs, and the industry's changing risk assessments we've talked about. And at the heart of it, for many people, is the California FAIR Plan.
The FAIR Plan, that's the state one, right? The insurer of last resort.
Exactly. It was originally established way back in 1968 after a series of devastating brush fires and civil unrest made it difficult for property owners to get coverage in certain areas. It serves as the state's insurer of last resort for high-risk properties.
Particularly in wildfire zones now.
Yes, especially those in wildfire-prone areas where private insurers have either pulled back, stopped writing new policies entirely, or non-renewed existing ones. Sometimes, as your feedback highlighted, just days or weeks before a fire actually broke out.
Leaving people completely exposed right when they needed it most.
It's a terrible situation. The FAIR Plan operates as a pool of all property and casualty insurers licensed in California. Basically, every company writing property insurance in the state has to participate, sharing in the FAIR Plan's profits, losses, and expenses based on their market share.
So the private insurers still have skin in the game, even with the FAIR Plan.
They do, financially. But the problem is, reliance on the FAIR Plan has just skyrocketed to unprecedented levels.
How much?
From just under 160,000 policies back in 2019, it surged to nearly 420,000 by June 2024. That's a massive shift in just 5 years.
Wow, almost triple.
And its total exposure, the value of properties it insures, reached an astonishing $393 billion. This isn't just an alternative option anymore. For many homeowners, especially in fire-prone regions, it's literally their only option for coverage.
But it's not great coverage, is it? Or cheap?
No, on both counts. The FAIR Plan offers bare-bones coverage. It's very limited. For example, it typically excludes common perils like water damage or personal liability, which are standard in traditional policies. You often have to buy a separate difference in conditions policy from a private insurer, if you can find one, to fill the gaps.
So it's complicated and incomplete.
And it's expensive, often 3 times as much more expensive than traditional policies, if you could even get a quote for one. Premiums have more than doubled since 2021, according to the sources.
Can you give an example?
We heard about a hotel owner whose premium jumped from $11,000 to over $62,000 in just a few years, and a Sierra Nevada homeowner who is now paying $12,000 a year for significantly less coverage than they had before. It's crushing for household budgets.
And it's not just the astronomical cost and limited coverage. There's also significant controversy and legal battles surrounding how claims are actually being handled by the FAIR Plan itself.
It seems the insurer of last resort is also facing accusations of being difficult to work with, maybe even using some of those delay tactics. What's particularly fascinating, or perhaps alarming here, is that even the state-mandated insurer of last resort is facing legal scrutiny over its claims practices. California's insurance commissioner, Ricardo Lara, has actually taken legal action against the FAIR Plan specifically for denying and limiting smoke damage claims.
Smoke damage. That must be huge after wildfire.
Exactly. It's a common and often devastating issue after wildfires, even if the flames don't reach the house. And a California judge even ruled that the FAIR Plan's policy on smoke damage was unlawful back in June.
Unlawful. So they were wrongly denying claims.
That's what the ruling suggests. Homeowners report being told their homes are cleaned by FAIR Plan adjusters only for independent experts they hire to find significant, lingering smoke damage. This leads to frustrating delays, inadequate payouts, and immense stress for families just trying to rebuild their lives and breathe clean air in their own homes.
So even the last resort option is problematic. What's being done to fix this mess in California?
Well, in a significant effort to try and stabilize the market and, ideally, decrease reliance on the California FAIR Plan, Commissioner Lara has introduced a sweeping initiative called the Sustainable Insurance Strategy.
Okay, sustainable insurance strategy. What does it do?
It's an overhaul aimed at enticing private insurers back into the market. The core idea is to give them some of the things they've been asking for.
Like using those forward-looking models.
Yes, allowing them to use those forward-looking catastrophe models we discussed, and also allowing them to factor in their reinsurance costs when setting rates critically, something that is currently not reviewable by the public.
So less transparency on rate setting, potentially.
That's the trade-off and the concern for advocates. In return for these concessions, insurers are expected to commit to writing more policies, particularly in those wildfire-distressed areas, to expand access and choice and take pressure off the FAIR Plan.
Expected to commit. Does that mean they have to?
That's where the details get tricky and subject to debate.
So it sounds like a complex give and take, a high-stakes negotiation. But what are the challenges and the public's reaction to this ambitious strategy? It feels like a gamble with homeowners' financial security.
It is indeed a high-stakes gamble, and consumer advocates, as you might imagine, are split on its potential. While some see hope for increased availability of private insurance and a reduction in the FAIR Plan's burden, which would be good,
Right.
others worry intensely about the affordability aspect. They fear it will inevitably lead to higher insurance rates for consumers without necessarily guaranteeing better service or fair claim practices down the line.
Will just cost more, but the underlying problems remain.
That's the fear. Some critics argue the plan has loopholes that could allow insurers to raise rates significantly while offering only marginal improvements in coverage or market access. It's widely described as a long-term game, with stabilization in the market hopefully appearing by mid to end of 2025.
So no quick fix.
Definitely not. There's deep skepticism about whether it truly has enough teeth to guarantee policyholders won't just see increased rates with no real improvement in access or service, especially given the historical patterns of alleged claims manipulation and profit-seeking we've already discussed. The question remains, will these changes truly protect consumers or simply give more power and pricing flexibility to the insurers?
And let's really bring it back to the people affected now. Your powerful, raw words from the listener feedback. Homeless or old, or 83 and dead. The usury continues. They cut right to the core of what many people are feeling.
It's visceral.
They speak to the devastating long-term impact on people caught in the system. Let's really explore the profound human cost and this alleged war of attrition that many policyholders seem to face. It's not just about money, it's about lives.
This sentiment, articulated so powerfully in the material you provided, encapsulates the heartbreaking reality for countless individuals. The alleged McKinsey method tactics we discussed earlier, the relentless delay, making outrageously low offers, and the aggressive instruction to go after him hard if policyholders dare to protest.
They're boxing gloves.
Right. These are not described as accidental inefficiencies or simple mistakes in the testimony. The sources strongly suggest they are, in fact, allegedly designed as an explicit attrition strategy. The goal is described as wearing down policyholders over years and decades until they are utterly exhausted, financially ruined, or tragically, as that quote implies, no longer alive to fight their claim.
So the company wins by default if the person just gives up or passes away.
This strategy effectively makes outlasting the policyholder an alleged core feature, not a bug, of the system, a truly cynical approach to what should be a safety net.
What are the immediate consequences of this alleged attrition for people?
The immediate devastating consequence is the sheer financial and emotional toll it takes. We heard the story cited earlier of Charity Jackson, a California hotel owner. She was forced to make the impossible choice to go without fire insurance for her business simply because the soaring costs became unbearable.
She just couldn't afford it anymore.
Right. She acknowledged it was a huge risk that left her completely not covered, but felt she had no other option. This is the stark reality many are facing. Either pay exorbitant rates for often inadequate coverage or risk losing absolutely everything.
It's an impossible choice.
It is. And this isn't a path to more money for people. It's a direct route to potential catastrophe for small business owners and homeowners alike. And think about the psychological impact being in perpetual limbo, constantly fighting for what is rightfully yours under your policy while facing the threat of losing your home or business. It's immense and often leads to severe mental health strain, anxiety, depression.
And the ripple effects of this extend far beyond individual policies and personal tragedies, right? These alleged practices and soaring costs impact the wider economy and the very fabric of societal well-being. This feels like a systemic issue, not just individual bad luck or isolated incidents.
If we connect this to the bigger picture, the societal impacts are indeed profound and far-reaching. For example, the sources state that spiraling homeowners insurance costs are causing delinquencies on mortgages to rise.
People can't afford both the mortgage and the skyrocketing insurance.
Especially for vulnerable groups like FHA borrowers. These individuals typically have lower credit scores, higher debt-to-income ratios, and minimal savings, making them acutely sensitive to unexpected cost increases. Imagine, as in the example cited of a Sierra Nevada homeowner, seeing your property insurance jump from $7,000 to $12,000 a year. That's a $5,000 hit, a significant unbudgeted dent in most family finances.
That could be the difference between making the mortgage payment or not.
Exactly. And many aspiring homeowners are now finding they can't even obtain the required insurance due to prohibitive costs, effectively preventing them from purchasing homes altogether. This dampens the entire housing market.
And it goes beyond property, too. You mentioned health insurance earlier.
Right. The lack of adequate insurance has wider implications. In health insurance, for instance, the U.S. still has over 40 million uninsured Americans, according to the data mentioned. Out of necessity, they often miss crucial diagnostic procedures.
So problems get worse before they seek care.
Precisely. Leading to untreated conditions only addressed in emergencies, which is far more expensive and often drives patients deeply into debt. The Affordable Care Act, or Obama's Acts, was explicitly designed to tackle problems like selection bias, where only sick people buy insurance, driving up costs and moral hazard, where people might take more risks knowing they're insured. By requiring coverage, the goal was to broaden the risk pool and lower overall premiums.
Insurance also drives safety standards, doesn't it?
It can, or the lack of it removes incentives. The sources contrast the devastating lack of insurance in Haiti after its earthquake, where there were no insurance companies imposing building codes and standards, leading to greater devastation. Compared to, say, New Orleans after Hurricane Katrina. While still catastrophic, the presence of more insurance created an incentive for rebuilding to meet certain codes. Even major correlated risks like terrorism were traditionally excluded from policies until government intervention, like the Terrorism Risk Insurance Act, TRIA, became necessary to provide a backstop and keep construction projects going post 9/11.
Which brings us back to that incredibly powerful statement pulled from the listener's feedback and deeply resonant with the sources. The system for effing everybody over isn't changing. The people come and go, the agents come and go, the usury continues. That really sums up the deep-seated, entrenched nature of this problem, doesn't it? It speaks to a profound cynicism that many people feel.
It does, and it reflects a truly ingrained systemic issue, suggesting it's not just the isolated actions of a few bad actors, but potentially a foundational problem within the industry's structure and incentives.
The structure itself leads to this outcome.
Well, the pattern of corporate denial and amnesia at the top, even when faced with overwhelming evidence of misconduct, coupled with fragmented regulation and that inherent massive power imbalance between multi-billion-dollar corporations and individual policyholders, it makes systemic change an incredible uphill battle. The sources suggest that the alleged McKinsey method, driven by immense profit potential and a focus on maximizing shareholder value above all else, was potentially so successful that it became basically industry standard across the industry. This pervasive influence, combined with the industry's well-documented ability to lobby effectively for regulations that favor its financial interests, creates a kind of self-perpetuating cycle where, as that listener put it, the usury continues despite widespread public outcry and immense human suffering.
It's a bleak picture.
That quote perfectly captures the despair of those who feel trapped in a system designed, perhaps, to outlast and outmaneuver them, leaving them potentially in the end with nothing despite paying premiums for years.
So we've painted a stark picture of an industry deeply entrenched in practices that often seem to prioritize profit over protection, leaving a trail of frustration and financial hardship. It's quite heavy stuff.
It is.
But in a world rapidly reshaped by technology, does artificial intelligence offer a path to redemption for the insurance industry? Or, will it simply create new, more sophisticated ways for the usury to continue, as that listener feared? Let's pivot to the future now. How is technology, specifically AI, playing a role in this industry, and what new opportunities or challenges does it present?
That's a critical question for the future of this industry, absolutely. AI is indeed beginning to make significant inroads, often starting with what the industry calls the low-hanging fruit areas where efficiency gains are easiest to achieve.
Like what? Better phone systems.
Exactly. Carriers are now widely using AI voice fronters to replace those, frankly, terrible IVR experiences. Those automated phone menus that always seem to lead you in circles.
Oh, I know them well. Press 1 for.
Yeah, right. AI can actually answer every single phone call, triage customers much more accurately to the right department for routine tasks like making payments or adding a vehicle to a policy.
So getting you to the right place faster.
Potentially, yes, and provide instant accurate information for simple questions. This streamlines processes, reduces call wait times, and can notably improve customer experience, at least for basic inquiries.
Okay, what else? Claims.
Yes, we've also seen AI being rapidly deployed for claims intake, especially during catastrophic events. Think hurricanes, major storms. Human call centers would otherwise be completely overwhelmed.
So AI handles the first report of loss.
It can. For instance, the sources mention Liberate Innovations, a company in this space. They were able to facilitate the filing of close to one claim every 6 seconds during a recent hurricane season with minimal human involvement.
Wow, that's fast.
It dramatically speeds up the initial reporting process. Though, of course, human adjusters are still needed for assessment and investigation down the line.
And buying insurance directly.
Yes. For more basic, less complex products like renter's insurance or even simple auto policies, AI is enabling direct-to-consumer paths, allowing customers to self-fulfill policies online or via voice, making the process much quicker and more accessible for straightforward needs.
Okay, these sound like potentially significant improvements to efficiency and, for some interactions, customer experience. But with any powerful new technology like AI, especially when applied to an industry with such a contentious history, there must be considerable challenges and gray areas, particularly when it comes to legal, ethical, and data privacy implications. It feels like it could be used for good or not so good.
Absolutely. The gray areas are plentiful, and the regulators are scrambling to keep up, especially concerning legal and regulatory risks.
Like what, specifically?
Well, for example, for outbound dialing, like if an AI calls you, any AI-generated voice is considered an artificial voice under the Telephone Consumer Protection Act, TCPA, in the U.S.
Okay.
That means it requires specific consent levels from you, the consumer, and specific disclosures like clearly stating who they are, providing a callback number, and offering an easy, automated opt-out. Compliance with abandonment numbers under the Telemarketing Sales Rule, TSR, which limits how many calls can be dropped if no agent is available, is also crucial.
So they can't just robocall you easily with AI.
Not without risking hefty fines. And old consent language you might have agreed to years ago, like allowing calls from an automatic dialer, may not be legally robust enough to cover AI-generated calls. Companies likely need new, specific consent for AI contact to avoid massive legal risk.
What about the agents? Does AI replace licensed agents?
That's another huge gray area. There are significant questions around the legality related to agent licensing when using AI for tasks that might involve actually binding a policy, making it official, or making substantive changes.
Because usually a human agent needs to do that.
Right. Most states currently require a licensed human agent to perform such actions. And there isn't much clear guidance yet from regulatory bodies like the NAIC on how AI fits into this framework.